Today's topic, fiscal policy.
Hello students, today my discussion will be in the ISA syllabus, fiscal policy. This chapter, fiscal policy. This is a very important chapter. Now, under in this chapter, fiscal policy, what are the topics included? The first thing is public revenue, then public expenditure, public debt, and deficit financing. By the way, the last topic which I said, deficit financing, only the meaning is there in the syllabus of ISC. Only the meaning, what is deficit financing? See, when the government has a deficit in the budget, the expenditure is more than the receipts. Then the government has the need to fulfill that gap between the expenditure and the receipts. And the government can fill that gap by making new money, by printing new currency notes and coins. So this process is called deficit financing. Now I come to public revenue. Now under public revenue, the most important source of public revenue is taxes. Tax. Firstly, the definition of tax. What is a tax? A tax is a compulsory contribution by the individuals or organizations to the government to ensure that the government can run the country or the state in a proper way, to make all the expenses which are required by the government for running the country or the state in a proper way. So tax is defined as a compulsory payment, compulsory contribution from a person or an organization to the government to defray the expenses which are incurred by the government for the common interest of all. So this is the definition of tax. Now, in case of the definition of tax, it is also said that a tax is imposed by the government on the individuals or organizations without any reference to special benefits conferred. So, in the characteristic of tax, we can say there's a very important term. There is no quid pro quo. No quid, Q-U-I-D, quid pro, P-R-O, pro, quo, Q-U-O. And this term, quid pro quo, means proportionate return. So in case of tax, there is no assurance of any quid pro quo, that means any proportionate return. Nobody can claim any special benefit to be given by the government to that individual because the person is paying the tax. So that's a very important characteristic of tax. Now, so you all must know the meaning of this concept, the meaning of this term, quid pro quo. Secondly, tax is a compulsory contribution. It is a must, it is mandatory, it is compulsory for every individual or organization to pay the tax. Next is, tax is a personal obligation. It imposes, tax is that it imposes on persons, and it is a duty of the taxpayer to pay the tax. It is a crime not to pay the tax or to avoid the tax. It is a crime. And lastly, tax is given by the people to the government for ensuring, for enabling the government to make general benefit for all, for making the general welfare activities, for doing the activities which will make the general benefit for all the people. So that is regarding the definition of tax and the characteristics of tax. Now we come to, regarding tax, impact of tax and incidence of tax. That's a very important concept, impact of tax and incidence of tax. See, impact of tax refers to the initial effect of the tax burden. The initial effect of the tax burden on a person on whom initially the tax is imposed. Initially, on whom the tax is imposed, the effect of the tax burden on that person, that is impact of tax. Whereas incidence of tax refers to the ultimate effect of the tax burden on that person who ultimately pays off the tax. So that's the difference between impact of tax and incidence of tax. Now we come to the two major types of tax: direct tax and indirect tax. Direct tax and indirect tax. The basis of the difference between direct tax and indirect tax is actually that concept: impact of tax and incidence of tax. In case of direct tax, the impact of tax and incidence of tax are on the same person. Whereas in case of indirect tax, the impact of tax and incidence of tax are on different persons. Because in case of direct tax, the burden cannot be shifted. That very person on whom initially the tax is imposed, that very person, that same person has to pay off the tax ultimately. Whereas in case of indirect tax, the tax burden can be shifted from one person to another. So this is another difference. In case of direct tax, the burden of the tax cannot be shifted from one person to another. In case of indirect tax, the burden of the tax can be shifted from one person to another. Thirdly, direct taxes are based on the income earning and the assets and the properties. Whereas indirect taxes are based on the expenditures. So that is another difference. You can also write that direct taxes are paid directly by the people to the government, whereas indirect taxes are paid, in case of indirect taxes, that these taxes are paid indirectly. You can write this point that direct tax, in case of indirect taxes, the tax is paid in splitted parts. One person paying to the government, then that person can reap the tax from another person. That second person can reap the tax from another person. So the burden is getting shifted. So these are the differences between direct tax and indirect taxes. Mind it, merits and demerits of direct and indirect taxes. In the current year syllabus of ISC, merits and demerits you don't need to study. Mind it, you don't need to study. Now we come to the next types of taxation. The types of taxation, I will come to that. Types of taxation, 4 types of taxation. Basically these are 4 types of income taxation: progressive, proportional, regressive and degressive. Progressive tax is that type of tax in case of which, when the income of the taxpayer, the tax base increases, the tax rate also increases. That is progressive tax. I repeat, when income of the taxpayer, that is the tax base, increases, the tax rate also increases. So that is the gist that you must remember. Income of the taxpayer, the tax base increases, the tax rate also increases. We come to proportional tax. In case of proportional tax, when income of the taxpayer increases, that is the tax base increases, the tax rate remains same, the tax rate remains constant. And that is why here, in case of proportional tax, the tax amount increases in the same proportion as the income increases, the proportion of the income. Thirdly, now we come to regressive tax. Regressive tax is exactly opposite to progressive tax. In case of regressive tax, we find when the income of the taxpayer, that is the tax base, increases, the tax rate decreases. When the income of the taxpayer, that is the tax base, increases, the tax rate decreases. Now one thing, practically this particular type, regressive tax, is not applicable in any country. Because if this is applicable, practically not applicable. Because if this is applicable, if this is applied, then the poor people have to pay comparatively more tax and the rich people have to pay less tax, which is not justifiable, which is not at all justified. Now we come to the 4th type, the last type, which is digressive tax. In case of digressive tax, the rate of progression in the taxation does not increase in the same proportion as the increase in income. Now, specifically what happens in case of digressive tax? You need to be specific while writing. In case of digressive tax, initially when income of the taxpayer, that is the tax base, increases, the tax rate also increases. But after a certain level, when income of the taxpayer increases furthermore, the tax rate remains constant. I repeat, initially when income of the taxpayer increases, the tax rate increases. But after a certain level, when income of the taxpayer increases furthermore, the tax rate remains constant. So this is digressive tax. So that's the end of taxation part which you need to study. From here only questions can come. Now I come to the next topic, which is public expenditure. The meaning is very easy. Government's expenditure. Government's expenditure for various activities. It can be central government, it can be state governments, it can be local self-governments. Their expenditures for various purposes, for various activities. That is termed as public expenditure. Now, apart from the meaning of public expenditure, what you have in the syllabus is the importance of public expenditure, like effects of public expenditure on production, effects of public expenditure on production, like public expenditure helps in generating income for various individuals and firms, because government spends money for purchasing various goods and services from the firms, from the people, and then the people's income earning will increase, the firm's income earning will increase. Secondly, public expenditure can help in increasing production in the economy by increasing the efficiency of the people. How? Because government spends money for education, for medical sector, for sanitation, for housing facilities. For these activities, when the government spends money, then automatically the efficiency level, the efficiency of the laborers, of the workers, of the people increases. And that will lead to ultimately increase in the efficiency of laborers. Next is public expenditure can be used to create human skills, just like I said, education. When the government spends money for the education sector, making new schools, making new colleges, making new universities, spending more money for the education sector, that will create improvement, development of the education sector. That means human skills are being improved. Next is public expenditure can be used as a means of producing essential raw materials and other important inputs in the public sector. In the government sector, government can establish industries where some machines, some tools and implements, some raw materials will be produced, and the production of these can remove the shortages if there are some shortages in the economy. Next is public expenditure is helpful in promoting the development of basic and heavy industries, basic and key industries, like establishing iron and steel industries, like fertilizer industries, heavy engineering goods industries, capital goods industries, these. Now, public expenditure incurred in providing social security schemes like old age pension, unemployment allowances, sickness benefits, accidental benefits, these will also increase the willingness, the urge of the people to work more, to work in a more dedicated way, and then also the production will increase in the economy. So these are the points which highlight the effects of public expenditure on production. Now we come to effects of public expenditure on investment. Firstly, public expenditure on the maintenance of law and order. If the government spends more money to maintain, to improve the law and order of the country or the state, then the people, the investors, the people who are the investors, they will have more faith, they have more confidence, and hence it encourages the investors to invest. They will not suffer from insecurity. Next, public expenditure can be directly used to create social overheads in the form of human capital, because that is also a form of investment. When public expenditure, government spends money to create more and more, better and better human capital. Now, creation and maintenance of economic overheads such as power, electricity, irrigation, transport, communication. These would motivate the producers to undertake investment. In this way also, the investment in the economy can increase. Next, the government may provide financial help and give subsidies to the private sector industries also if required. And by this way also the government can stimulate, can promote, can encourage investment. Now, effects of public expenditure on the income distribution. Like public expenditure can be so devised, can be so made, arranged in such a way so as to help the poor section of the society and thereby reduce the income inequality. That means the gap between the rich and the poor can be reduced by making the public expenditure, by incurring the public expenditure in a suitable manner. Like public expenditure on social security and welfare measures like free education, free medical facilities, social security schemes like old age pension, unemployment allowance, these can be given, and in that case more priority will be given to the poor sections of the society. Now, if the government gives more priority to the poor sections of society and to them specifically, more monetary benefits are given, then the income inequality in the economy can be reduced. Next is, public expenditure can be effectively used in reducing regional imbalances, regional disparities. Now, in a country like India, we have regional imbalances, regional disparities are there. Some states are comparatively more developed, some states are comparatively less developed. Then, if the government takes the initiative and the government establishes some industries, some employment generation programs, some units, industrial units in those areas which were backward and underdeveloped, those areas, those regions, those states which were more backward, underdeveloped, then there can be reduction of the regional disparities and regional imbalances. Next is effect of public expenditure on economic growth. Public expenditure can promote economic development or economic growth directly by developing economic overheads and infrastructure, by establishing capital goods industries, basic and heavy industries. Public expenditure may stimulate, may encourage, may promote economic development indirectly by providing education, training and research facilities. Because if education, training, skill formation, research facilities are improved, are developed more and more by the initiative of the government, then definitely the production of goods and services in the future will be enhanced. Next, public expenditure in the form of subsidies. You know what are subsidies? When the government gives a part of the cost of production of some industries, that is called subsidy. So public expenditure in the form of subsidies can help in stimulating, promoting, encouraging agricultural and industrial development. Public expenditure policy can be effectively used to reduce glaring disparities in income and wealth. That means income inequality, wealth inequality can be reduced. Public expenditure helps in achieving the growth with social justice. If the public expenditure is incurred in this way so as to reduce the disparities in the income and wealth, like government giving more benefits, more priority to the poorer sections of the society. Like, for example, there are two types of ration cards. One is called BPL ration card, one is called APL ration card. To the BPL ration card holders, that means below poverty line ration card holders, the government spends more money and gives them food items like rice at a very, very low rate. Then see, more priority is given to the poorer sections when the government bears the burden and spends more money to make them uplifted. So this is another way in which the economic growth can be achieved. Next is public expenditure and economic stability. Yes, there are phases in which there is inflation or there is deflation. Ups and downs in the economy can be occurring. There can be recession period, there can be inflation period or deflation period. Booms and recessions are there. But the government's objective is always how to maintain stability. Then in that case, public expenditure can also be helpful. Like when there is inflation, it is assumed that the aggregate demand is more than aggregate supply. And as there is increased aggregate demand, that is why inflation has occurred, because of demand pull inflation. Then the government's objective will be to reduce the aggregate demand. Then in that respect, government will be, for the time being, temporarily for the time being, the government will be reducing the public expenditure. For the time being, the government will stop or reduce public expenditure. Whereas in case of recession or deflation, in case of deflationary situation, what happens? Prices are falling down. The producers community, the producing sector gets demotivated. Aggregate demand is less, aggregate supply is more. Then in that case, when aggregate demand is less, now the situation is just the opposite. Now the government needs to encourage demand, to promote demand, to somehow to raise the demand. Then public expenditure will have to be raised, will have to be increased. Government will spend more money for various activities. Now, if the government spends more money for various activities, maybe industrial establishments will be made, maybe agricultural development, maybe education sector development, medical sector development, all these, government will spend more money, and that money, that increased money supply, that increased money will be going to different people, different categories of people in the whole society. So in that case, this can reduce the instability, and that can bring about, that can restore or bring about economic stability. So this is all about the public expenditure that you need to study and learn. Now I come to the last topic in this chapter, public debt. That is the last topic, public debt, DEBT, debt. That means government taking loans. Government taking loans, that is public debt. It can be internal public debt, it can be external public debt. When it's internal public debt, government takes loans from internal sources, and when the government takes loans from external sources like World Bank or IMF, then those can be termed as external public debt. Now, the most important topic regarding public debt, according to ISC syllabus, is methods of public debt redemption. Repayment of public debt. That means redemption. Public debt redemption, the methods. Various methods are there. Number one, the first is repudiation. Now, repudiation means, the term repudiation means refusal. Refusal to pay back the loans, the debt which was taken by the government. When the government repudiates public debt, it does not recognize its obligation to pay the loan. It refuses to pay the interest as well as the principal sum. But mind it, this particular method is not practically applicable. This is not a normal condition. This is not a normal occurrence. So this is a very unusual, very unrealistic thing. Still, the provision is there. Second is refunding. Refunding is the process in which the government feels the burden that the government has to repay the outstanding dues, outstanding debts. For that, the government takes new loans. Again, the government will sell bonds to take new loans in order to pay off the outstanding debt. Outstanding means dues. Previous loans, previous principals of the loans and the interest are to be paid back. And for that, the government is taking new loans. And for taking the new loans, the government sells new bonds. This is called refunding. Next is debt conversion. Debt conversion. Earlier, in the past, when the government had sold the bonds in order to take loans, the government had sold the bonds in the past. And at that time, maybe the interest rate was higher. But now, when the government feels that it is troublesome situation for the government is not in a position to pay back or repay the previous loans in a very smooth manner. There is dearth of money, there is shortage of money for the government. So now the government can reduce the rate of interest for those bonds. So this is debt conversion. Debt conversion from higher interest bonds to the lower interest bonds. That is the debt conversion, from high interest or higher interest bonds to the low interest bonds. The next is sinking fund. Government creates a separate fund in which the government will pool, P-O-O-L, pool means deposit some amount of money. Every year the government is depositing some amount of money in that separately created fund, and maybe after 2 years, after 4 years, after 10 years, when the government is supposed to pay back the outstanding dues or debts, principals on the loan along with interest, then that money which has been deposited year after year and in that sinking fund, in that separately created fund, the total amount accumulated will be a large amount of money that can be utilized, that can be used to pay back the outstanding loans. Next is capital levy. Capital levy. Capital levy refers to a very heavy tax on the properties and assets and wealth. So this is also not a very good measure or method of public redemption. Capital levy is a very quick and equitable method of debt redemption or debt repayment. But the situation is, the thing is, capital levy, this measure, this method is adopted by the government in some emergency situation when the other sources are stopped, other sources are not available, not so much easy to adopt the other sources, other measures, then like in a war situation. In a war situation, the government can adopt this, that is capital levy. Now another method can be export surplus. This method where the government can create export surplus if foreign loans are invested in those industries which produce exportable goods, the loans may be easily repaid. So export surplus from the exports which are enhanced, which are promoted, which are encouraged, which are increased, more receipts will come, and from that surplus which is created because of the exports, the outstanding or the previous loans can be repaid. So this is export surplus. Next one is terminable annuities or terminal annuities. Now under this method, terminal annuities or terminable annuities, the government pays its debt in equal annual installments which include the interest as well as the principal sum of the debt. Equal annual installments, and that is why it's called annuity. So these are the methods of public debt redemption. That's all. I have discussed the different topics which are in this chapter, fiscal policy, which you need to learn. You can boast on these. Thank you.